great future. We're talking real money.
That's the sound of the can getting kicked down the road. Wait. Okay, stop can. Stop kicking the can, Congress.
I thought you were cracking into the beer early before the show was over there, but okay.
Yeah. That's this is the problem with doing a live show. I'm hearing back from you.
Me too.
Really? How weird is that?
I know it's over.
I don't know what it can be.
Over again.
Hold on, let me take my headphones off.
I've turned my mic off. I've turned my mic on. I've danced all around, and here we are.
Oh, that's weird. It's not coming. It must be coming back through the station. Oh, it's at the station. There's something said at the station that's wacky on our mix minus, which I hate to talk about on the air, but I hope they're not hearing it on the air. Hello again, Don McDonald here. And again, the dilemma is live show becomes podcast later. So how do we talk about things that are happening literally right now as we're doing the show? Literally right now. I mean, the House of Representatives just held a can-kicking vote to give us 45 more days of government. Yay. So we don't have to. We were going to talk about the shutdown.
Yeah, well, but I mean, we're in a kind of an odd place, as you said, because if you're listening to this later, then it's anticlimactic, assuming the U.S. Senate comes through and approves this temporary stopgap measure as well. But the lead up to this has been a little awkward, not just politically, but economically, because a lot of people have been like, this is going to be bad, right? This is going to be bad for stocks and bonds, et cetera.
The reality is, though, this has happened before. Oh, it's gone now.
It's gone.
Oh,
feels
like
so much
magic.
better.
I feel so much better now. Oh, it's like a relief when it's gone. The echo's gone.
It really is.
I'm just like, oh, I feel so much better. This has happened before, and my guess is, given the political climate in this country and others, we're not the only one. It's a little wacky right now, but given the political climate in the United States and other countries, my guess is this is something that will probably happen again.
Yeah,
maybe in 45 days.
Yeah, probably likely. And for those of you who are worried about this and what it would mean to stocks and stock markets, for example, not as bad as you might think. It's fascinating. History, if you're using history as a guide?
We always do.
Shutdowns?
We love history as a guide.
20 shutdowns since 1976?
Yes.
Stocks rose half of the time during the shutdowns. So that means they fell half of the time, which sounds about like what they do regularly, right?
Yeah. Yeah, because we're talking about short periods of time. Over longer periods of time, it's like over a year, it's a 75-25-ish.
Yeah.
Stocks go up more than they go down. But day to day, it's about a 50-50.
Yeah. So not a whole lot of change there.
Yeah. Which is why we really need to this is why we've even done classes on this, on turning off the noise, of ignoring the noise at least. But you can turn it off by paying less attention to it. Anytime somebody's trying to evoke financial emotions, they're usually doing it for some selfish reason, whether it's to boost ratings or to sell you something. There's usually a nefarious purpose involved. So you, as a consumer and as an investor and as just a human being who'd like to live a normal life, well, you need to ignore all of that noise or it will make you crazy and make you do stupid things.
And we've seen a lot of those. We've seen people selling out of stocks. We've seen people selling out of bonds. We've seen people moving to cash, and that's not what you wanted. That's not investing. That's market timing. That's trading, and that is bad for your financial health. But the show's about you, not about us.
Right. So we need you to call us.
People call.
If you have questions, we got rid of the echo. Now all we have to do is work you into the program. And what you need to do that is to call us at 855-935-TALK, 855-935-8255. We've got lines open for you. And if it is a money question, concern, even a comment, we want to hear it. and we want you to call us. 855-935-TALK, 855-935-8255. It is so free. It is so easy, and we would so love to spend some time talking with you today because we are here. We're here almost every Saturday. Rarely are we not here live with you. We think this is the most important thing we can do, and for you, too.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, during the break, we figured something out. Our toll-free number, for some reason, is not properly forwarding as it's supposed to in its program. So something's happened with the service that provides that service to us. Grasshopper.
I think it's part of the shutdown.
Could be. They shut down our line.
Yeah.
So I want to give you a new number. So take this down. This is a new number. This is for today. 206-644-6009. 206-644-6009. And really...
Is that 206-644-6009?
Yeah, 206-644-6009.
Okay.
Yeah.
Is that toll-free?
No, but who cares? Really?
Just kidding.
When was the last time?
In today's world.
When was the last time you paid for a long distance call? Do you remember? I don't even remember.
No, me either.
I mean, it's got to be
bygone era.
It's got to be a couple of decades, doesn't it? No, I'm thinking.
Seems.
Yeah. Anyway, so that's our number. 206-644-6009. I'm Don. That's Tom. This is money we're talking about. And, you know, a lot of people were worried about the possibility of a government shutdown, as we talked about earlier, which, by the way, looks like it'll go to a Senate vote today in a few hours. Hey, maybe during the show. Ooh, whoa. We can break news.
Live.
Breaking news on Talking Real Money. And then, of course, you're going to be listening to a replay of this as a podcast next week. But here's the thing. What could have happened pales in comparison to what did happen, or is it possible that since the potential shutdown was in the news, that the market baked it in to those terrible September numbers, Tom?
Yeah, they're pretty awful. Standard & Poor's 500 down 5% for the month. And for the soon-to-be hopefully forgotten third quarter, down 3.8%. NASDAQ, well, that's off 6%. By the way, none of the Supreme 7 stocks saved you either. You know, Microsoft, Meta, all those.
None of them worked?
Either. Nope, none of them worked. The NASDAQ off 4.3% for the quarter. And by the way, so I love these comments from the analysts. The market only a few months ago was worry-free amid the belief that the Fed could engineer a soft landing. And now the market's worry closet is wide open as investors raise questions about the economic outlook, about fuel prices, about the potential for another rate hike. You got UAW on strike. Ukraine war continues. Shall I continue with the list, or is that enough?
No, you can go. You can continue. I don't mind.
Okay. How about a little longer look at things?
A longer look would be good. Yes. What have you got? Let's look back farther.
Less painful.
Take a trip back in time.
100% global stock portfolio, all in stocks since January 1st, up 4.6%. The Standard & Poor's 500 up 13%. And how about a sort of middle of the road 60% stock, 40% bond portfolio, up 3.9%. So still positive. And, the bond funds are negative again here for the year, most of them, because of the increasing rates and the yield. I just looked up at the intermediate term bond fund at dimensional funds up to at 2.2. And the BND is
the BND.
Call me at the BND. It's up like 4. No, it's not up. It's the yield is about 4.7%. So you can make some money in bonds again, apparently.
That is actually a really good yield for a broadly diversified bond fund like that. That actually, is that better than the yield on my bond ladder? I think it might be.
No, you mean your CD ladder?
I mean my CD ladder? No, my CD ladder was like 5.16 or something. Yeah. So I did do the CD ladder, and it's so nice to look at my statement and see, like zero movement. Like I go price change from yesterday to today, 0, 0, 0, 0, 0. Whereas I look at AVGE and I see it's down 1/3% or whatever.
But they're going to get the interest on all those things as the months move along here.
Right.
Yeah.
It's great. I'm really liking the balance of my portfolio. The equity I mean, I have AVGE. Just to let everybody know, I have AVGE, I have VT, VBR, some CDs. It's just well diversified and simple and well diversified.
You got CDs, but no DVDs, apparently.
Actually, we still have some DVDs downstairs, and I keep telling Debbie why she's keeping all the Disney DVDs. And it's got.
My wife has Elvis records from 50 years ago. Actual LPs. So.
I've got Disney Plus. If the grandkids want to watch Disney stuff, they don't want to watch those old ones anyway. They want to watch all the new stuff.
What do they want to watch?
I don't know.
Yeah.
They love Bluey.
Mine coming over. I don't know Bluey.
Oh my God! You don't know Bluey?
I know Cub Bluey, but not
Bluey. Is actually quite funny, and it's I kind of even like it as an adult because it's written tongue in cheek. It's got a little adult humor. Not
the
adult
good news
humor.
is there's as bad as it's going to be for television here for the next 3 or 4 months with new releases coming basically to an end.
That's why I started watching Australian shows.
Yeah, good TV from down under. So anyway,
no, they're very good. In fact, did I tell you which ones?
No, apparently he told my son, who said he tried to watch them for a couple minutes and just couldn't figure them out. So he said no.
Deadlock? Well, Deadlock's a little weird. Yeah.
Yeah. You like stuff that's a little
But Fisk is not. Fisk is very mainstream Australian.
Fisk?
Fisk. It's on Netflix. It's funny. It's very funny. It's kind of Office funny. The Office kind of funny.
I haven't finished watching Suits. When I'm done with that, I'll move on. So we'll see.
Gosh, we watched Suits back when it was on USA Network.
I'd never even heard of it until 3-4 months ago. Yeah, there it was. And
we've done that. We've been there, done that.
Love the Duchess of Sussex. She's great on there.
Yeah, she wasn't that then.
I know.
Okay.
Maybe that got her this role. I don't know. Maybe that role got this one.
And another one. I bet you haven't seen this one. Only Murders in the Building.
No,
it's on Hulu, and you don't have Hulu. That one is great. Hulu. Let me tell you, they've had Sting in it. They had Mel Brooks in it. Matthew Broderick. It stars Steve Martin and Martin Short, and that young woman who's like she was a Disney. I can't remember her name now.
Taylor Swift?
No, she was a Disney person. Gosh, Selena Gomez.
Oh, sure.
And the cast, it's just unbelievably good. Now, is this talking real money or what? Talking? Well, no, you mentioned something about DVDs, and this is where it goes when we do this.
That's bad. Yeah, okay.
But this is a great way to spend a little less money than you spent on DVDs. And enjoy some good television. And by the way, one of the money-saving ways to do subscription television is to find a subscription service that has a number of shows you want to watch. Subscribe to that, cancel all the others, binge the heck out of that channel, cancel that, go to the other one. That way you don't pay monthly for all of them. There, a money-saving tip for TV viewers. 206 something.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
was a weird start to the whole show. Just weird. We had the phone number problem. Suddenly, the House votes to destroy our topic.
Discombobulating. I mean, it was like,
and then, of course, you get some TV show suggestions. By the way, the weirdest of the weirdest shows.
I knew this wasn't going to end.
Is now I've forgotten the name of it. Mrs. Something.
Good.
Oh, I'm going to have to look it up. Okay. Anyway, our phone number. We're starting over again. Hello, everybody. Welcome to Talking Real Money. I'm Don. Tom's over there. We're going to try and help you deal with money this time. Not television, but money. 206-644-6009 is our temporary phone number for today. 206-644-6009. That takes you to the station, which then sends a little note to me so that I know you're there, and then Tom and I will speak with you about your money issues. Is that a better start?
That was really good.
Okay.
Yeah.
So then we're talking about how bad the quarter was. It was not a good quarter for equity investors. That
bond
happens.
investor either.
Or bond investors. Okay.
Sorry.
Let me go back. It wasn't a good quarter for investors. Better?
No, because if you were in a CD ladder, it was a good quarter.
It wasn't a good quarter for stock, bond, or crypto investors.
What about non-traded REITs?
I don't know. I didn't look those up.
That's not me either.
Gold was okay, though.
Gold was okay. Held its own, yeah.
What do you have to share with us other than those other numbers?
I have something.
I don't know what you have.
Because this is something
I
that
can't
comes
see.
up regularly. For 30 years, we've told you that one of the things you can control, you can't control the market, you can't control prices, you can't control the Congress, okay? We've given up on those things. But one thing you can control is your costs. Now, you've seen these come down dramatically over the last 20 years, the cost of investments. I'm talking about mutual funds, exchange-traded funds, et cetera. And this is a piece of news that is worthy of discussion but not worthy of change. State Street's S&P 500 fund, SPLG. Mm-hmm.
SPLG.
S&P 500. Yeah. They're charging 2/100ths.
Wow, that's low.
Management. 0.
Okay, but don't we get to a point where low is just so low you can't?
Well, but I don't think people should run out and automatically swap one out. With the exception, there's still products because we've talked about them. I think Rydex still has a S&P 500 fund where they charge you like 0.7. I mean, there's no reason to pay for an index fund of that. That's outrageous. That's crazy. It doesn't make sense. So, what I'm telling you here is, and we find this regularly on the program, we make suggestions oftentimes, and I find people, well, I just ran out and bought that because you talked about it on the show. I'm not saying that here. I'm simply saying this is something you should pay attention to because it does come up, right? I mean, if I was just buying the S&P 500 today, then I probably would use this fund because it's just the S&P. It's just an index. That's it. But I'm not telling you to dump. I always forget what's Vanguard's S&P 500 fund. It's
VOO is the ETF.
And what do they charge for that?
Oh, golly.
VOO.
Voodoo. Isn't it VOO? Maybe it's not VOO.
Yes, it is.
Is it VOO? Okay.
Yeah.
I'm just having VOO. Jeez, Morningstar is being really weird. Okay, there it is.
Expense ratio here.
It should be right here. Should be right there on this very slow to load page, Morningstar. I've been saying this for weeks. Oh, it's like a penny more expensive.
Yeah, 0.03.
0.03.
Yeah, so, I mean, again, but I'm just telling you, this is something, yes, to pay attention to. Don't do this you still need to own a wide variety of asset classes, you still need to be globally diversified, but you should be paying attention to these costs. They've come down dramatically, as I said, over the last couple of decades.
Now, I mentioned that crypto was also down, and I just wanted to make sure I was right, and I was.
The price
in the quarter. How much was the total stock market down in the quarter?
I don't have that number yet.
Okay, how much was the S&P 500 down in the quarter? For the quarter.
For the quarter?
For the quarter.
Standard & Poor's 500 down 3.8%.
Bitcoin for the quarter down 11.7%.
Which is getting harder because it's gone down so far. How many times can it keep going down by 10%?
Well, I mean, it's only just down to 27,000. It was 60 something. So,
wow.
Yeah. Yeah, that's volatile. I mean, that is truly volatile. And that's what we're trying to get you to avoid. That's why we talk about buying a diverse portfolio. That's why we talk about these costs. And again, I don't know how much lower they can go. What do you go from 0.02% to 1/100th of 1%? To 1/1000th of 1%.
I was waiting for that. Yeah, 0.0005.
Because there is, by the way, in Morningstar's expense ratios, there is another decimal now. It's not just 0.03, it's 0.030.
It's painful to me, but it reminds me of my chemistry score in high school, so I don't like to see those numbers.
0.0001?
No, there was a 5 in there somewhere.
206-644-6009.
And Don are talking real money. Reality radio for a really great future. We're talking real money.
The world is functioning now. Our phone number is, for a little while, 206-644-6009. As we, that's Tom and me, trying to help you muddle through your money matters. It's 206-644-6009. And Michael, you are up. Welcome to Talking Real Money. Thanks for calling.
Hi.
Hey, Michael.
Yes. Yeah, I have a question is I'm 69, retired. I do have a pension and a Social Security coming in. But downsizing, I have sold a small collection of cars. So I have some cash, and I'm trying to figure out what the best way is to do with the cash to invest it either for more retirement or for long-term care.
Okay. Well, that is probably our number one question with a bullet. I have money. What do I do with it? Here's the answer. We don't know yet, but we will know once Tom asks you some important questions.
Yeah, so, part one of this, Michael, is exactly what you just said. They're kind of the long-term aspect of this retirement. So you'd have to decide first on the purpose. Is this truly going to be money saved for end-of-life health care or eventual retirement or something else?
I think it's going to be near end-of-life health care. Like I'm 69, and both my parents are having issues, and one is right now their cost is about $10,000 to $12,000 a month, and so I'm wondering, I'm concerned about where I might be at that age. I may never need it, but I'm trying to make preparations just in case.
Which is a great idea. How much money are we talking about, though? Because that makes a difference. And the other thing we need to know is how much along the way are you willing to lose without panicking and doing something dumb like moving the money?
That's a good question. I say we're looking at about $200,000. Mm-hmm. I've got a good pension, a good retirement, and my Social Security, but I still have a little part-time business I run just to have fun. But it's about the $200K from selling some vintage cars I have, and that's what I'm trying to figure out what to do with it.
Right, but what I'm saying is that the risk tolerance issue, that is a really big one, and most people don't really know it, which is why for years we provided a free risk quiz at talkingrealmoney.com, which might be worth taking, because if you can afford to take, for example, the risks of the stock market over the next 10 or 15 years, you could triple that money, giving you a nest egg, over $500,000 pool of money from which to pay for long-term care, which would pay for many years of long-term care.
Conversely, you could do more balanced type of approach, and this is something you're going to do on your own. I'm assuming you're not going to hire somebody. And if you are, then you could use a balanced index fund. Vanguard is a very good one. You could, I'm not really favor target date funds in taxable accounts due to what happened to Vanguard recently. But so, something like that gives you, some stocks you're invested in, but a sizable amount of fixed income. So you have some balance there. The idea is to try to make, 6-7% over time, be willing to accept the volatility of 25% in a year, up or down, that kind of thing. That's
the volatility you should expect, too, is about 25% in a given year based on the past.
Okay.
I mean, does
So
that
where
sound
would
like
I
something
start
that
to
might be
look for something
comfortable
like
to
that?
you? Well, first off, is that
Yes.
if you lost 25% or $50,000 or so in a year, are you going to just leave it there and wait?
Well, I would presume that eventually that it will come back, and over the long term, it might maybe double every 10 years or something.
That's our assumption, and a double every 10 years is almost exactly right. A double every 10 years at 7% is a great expectation. If you could do, and what the 7% that Tom's referring to is based solely on the past. It is not anything like what the future is going to be, because we just don't know. But if the future is similar, then your 200,000 becomes over 500,000 at that kind of a rate on average. So as long as you can take that risk, but I would still go take the risk quiz at talkingrealmoney.com just to see where your risk tolerance is. And then, as Tom said, it's as simple as going to somebody like Vanguard and getting the Vanguard Balanced Index, which is very low cost and really, really simple. Thanks for the call.
Tom and Don are talking real money.
Do me a favor. Grab your latest investment statements if you know where they are. How many do you have? A lot? How many different investments are in each statement? A bunch? Do you own individual stocks, bonds, sector funds, and stuff you don't understand? Yeah, I thought so. I'm Don McDonald, and I'm pretty sure you have a case of hodgepodgeitis. But don't worry, it's not terminal and can be cured. But it takes three things: a bit of time, some fiduciary guidance, and a plan. There's a problem, though. Most financial advisors can't or won't provide any of those. That's where we come in. Tom and I will provide you the help you need to overcome hodgepodgeitis in a free, no-obligation meeting with an Appella advisor at TalkingRealMoney.com. So, scan or take a picture of all those pages you gathered, then go to TalkingRealMoney.com, click on Meet an Advisor, and set up a free appointment online or by phone when it's convenient for you. Let us sort through the mess and help you get started on a better, simpler future plan. Just go to TalkingRealMoney.com or call 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
Today's number is 206-644-6009. 206-644-6009 to talk about money with us here on Talking Real Money. And I just looked up the Vanguard Balanced Index. You know what the expense ratio is on that now for the fund?
0.18.
0.08.
Wow. Okay.
Oh my gosh, that's cheap.
And the reason that we suggested that to Michael is several. Number one is what Don just said. That's very inexpensive. Number two, this is one fund that holds pretty diversified group of stocks and then bonds and kind of a balance. The idea is here to give you part of the market return, not see you try to go straight up and not see you go straight down, kind of in the middle. You don't have to worry about it. They do all the rebalancing for you. It's all taken care of, and you can just put the money in there and hope for a decent return for a period of time. I think that's fair for many people that don't want to mess with this.
Yeah, if you want it, that's the thing. It's really, 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 really easy. Now, we would probably play with this a little bit. We would play with this a lot. We would add some more small cap and value and international and things like that, because this doesn't have any international. But if you just want incredibly simple, this is a decent way to go. We can make it more complicated and potentially add a little bit of return, potentially, based on some past research. But right now, this portfolio has 3,400 stocks and over 12,000 bonds. So, but it's U.S.
12,000
bonds.
Wow.
It's a lot of bonds.
Okay. Yeah.
Again, the phone number, 206-644-6009. And Jeff, you're up next. Welcome to the show. Jeff?
Me on. My question deals with ETFs. Mm-hmm. And my question is basically, is it a good cultural practice to use marketable limit orders?
You mean market or limit orders?
Well, it's called a marketable limit order, where you basically buy it whatever it is or sell it at whatever it's trading at that moment. You don't put stop loss.
That's a market order. There's a market. Well, yeah. It's a limit order with a okay. It's a market limit. Yeah, it's a market with a limit on it.
Marketable limit order where you. How do you feel about
okay. Yeah, I'm sorry. Yeah, that's an order that executes at or above or at or below, depending on which side of the bid you're on. Yes. So you are at or the market. So it's a limit / market order. I think we called it something different when I was a broker. I think we called it, I can't remember, but it had a slightly different name. But again, with ETFs, if you're using really popular ETFs, the float is so large that you are going to get a very good price with just a plain old market order. I mean, you could do it.
Okay.
You could certainly do it, but I just don't see the value in doing so.
Yeah, and I think we talked to Eric Barcelonas about this once, the ETF guy at Bloomberg, and his basic take was, fill it first thing in the morning and you're getting a fair price, is the way he looked at it, and he does this every single day. So this is maybe overthinking it a little bit.
Yeah, well, it's like hoping you're going to get a few cents more when you buy, or pay a few cents less. I'm sorry, let me flip that. You're going to pay a few cents less when you buy and get a few cents more when you sell, hopefully. But if the market's running against you, then it could turn around and bite you.
Okay.
So,
I was just I just converted from mutual funds to ETFs, and I was doing some research, and I was trying to
and
get
when you're
looking,
that's one of the things about ETFs, because they trade like stocks, people start to think like traders.
Yep.
Uh-huh.
I can remember the guy who really was in charge of Vanguard for a long time. This is one of the reasons that John Bogle was unhappy with the advent of exchange-traded funds, because he thought people were going to do exactly what you're doing, and this is converse to everything he said: buy and hold, don't pay attention, all these things like this that end up generally costing people. Generally.
Yeah, think about it for a minute. If you put in an order to buy at a set price or lower, and the price goes way up, well, now you're going to be chasing that ETF. And
okay.
And if I'm buying an ETF, I'm buying it for a reason. I'm buying it because it fits into my portfolio at that moment. I needed to get rid of X and buy Y. And I want Y in my portfolio, and I don't care if it's a few cents higher or a few cents lower. And that's literally what we're talking about, is pennies in cost differences.
All right. Well, that sounds like some great advice. I'll take that into consideration. I really appreciate your show. I'm a long-time listener.
Thank you so much. We appreciate it. I'm trying to remember what we called them when I was a broker. There was a different name for them. Wasn't a marketable limit. I don't remember. I'm old.
It's a long time ago.
It's a long time ago.
Yeah.
The number temporarily, 644-6009 with a 206 area code in front of that. And Sherry, you're next. Welcome to Talking Real Money. Sherry?
Yes.
Hi, Sherry.
Hi.
What can we do for you?
Are you ready for my question?
We are, yes, indeed.
I have a question. Okay. I have a question. My late husband died a few years ago at 55, and we had always planned to retire at 60, and I kind of want to keep on that track. I am about a year and a half away from 60, and I've recently had, my financial plan done, which basically I'm being told that I can retire even now. I'm somewhat skeptical and afraid, especially with the way the market is right now, if I should retire at 60 or 62. I do get a survivor's benefit, so I can retire at 60 with Social Security and investments. That would be fine. But do you feel like, because the plan is based upon the average market, and I think it was like 5% net average. Do you feel like it's wise to use that as a guide, or should I be using lower than market average in my planning?
So they're assuming a 5% average annual return in their assumptions.
Yes.
That's what it sounds like. Okay.
And did they do a Monte Carlo type analysis that looks at many different possible outcomes of your portfolio value?
Based upon, you mean like how the market does? Or?
Well, no, there's a program that can be run that shows you what the odds are of your money surviving in various market scenarios. It's a very complex hypothetical calculation.
Yeah, because I don't really like the idea of a straight line 5%, because there's no such thing as a straight line 5%.
But again, I think a 5% assumption historically has been a reasonable average return. But here's the question, really, Sherry. It's more of a lifestyle question. I know you're afraid of what the market could do, but if you have a properly constructed portfolio, the odds of you losing, if it's well diversified and you've got stocks and you've got bonds and you've got somebody rebalancing, the chances of you going to zero are limited. It really turns out to be a lifestyle issue. What are you going to do post 60 or post 62? And are you going to just stop making any money doing anything? Most people, it turns out, when they retire that early, go, do something else. So you really need to think of it in that way. Thanks for the call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And if you need more help than we can provide in the program, there is a way to get it, and to get it for free. You know, Tom?
Yeah, I mean, we do work with people every single day that don't pay us. We sit down with them, we talk to them, we tell them about their portfolio, we even do some planning. Yeah, some people.
And what do you usually find? What do you, just in 10 seconds, what do you usually find?
Most people don't have a plan, and they kind of have a discombobulated, you call it whatever,
hodgepodge.
That name you came from. Hodgepodge-itis. So most people, yes.
So if you want this meeting, it's really easy. You just go to talkingrealmoney.com and click on the link that says Meet an Advisor. Done.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?